I believe we're live. How is the sound?
Money keeps rising.
Really? Okay, testing. Testing. I think it sounds good. I believe it sounds good. Okay. Just make sure everybody gets a chance to filter in, and then we will get this show on the road. Wait a few more minutes. Get all my tabs up. Okay. Okay, anybody who's there, let me know if the sound is okay or if it's too loud or too quiet. Okay. And then we'll get this rolling. Hey, Hokage, I hope you're doing well. Thanks for the thumbs up. Okay, I think we'll go ahead and just get this show rolling. All right. Okay, quick little intro. Hokage, I know you're familiar, but for those who are not. Okay. This is my public YouTube portfolio series where I invest in a different company every week. Going into 2026, we're going to be doing $200 into a new company and $50 into an existing company that I believe to be the most undervalued. So as we are going into 2026, I'm still looking back on the full year here. We are currently beating the S&P 500. This portfolio is just a little over a year old. We started just at the very end of 2024, and we are up 28.9%, while the S&P 500 is up 19.96. So we've got a pretty solid lead. I'm very happy with that performance. And we don't just have a handful of companies. We have 43 companies now, I believe, maybe 42. The way we invest is we have a section for each sector of the economy. So I'm going to do my best to keep the sectors pretty evenly invested. Technology, though, is currently my highest. And so I'm working to even out my exposure to all the different sectors. And so this week I have been focusing on energy companies. And the screener that I have been using is this right here. I'm focusing on small cap companies. And I prefer companies that have lower volume. I like to focus on these companies because it is prohibitive for the big dogs, the big fish, to come in and invest in these small companies. So for instance, if a large institutional investor or a hedge fund is looking to invest, say, $1 billion, they can't really, they can't, like, or let's say they're wanting to invest $1 billion per holding. Let's say they want 10 holdings, each one's $1 billion. They're not gonna invest in small cap companies because they would, to make up $1 billion, they would need to invest in, I mean, what are we even talking about? 20 different companies just to take up a $1 billion chunk? It's not feasible. The amount of due diligence that they would have to perform on all these companies would take too much time. It's too difficult. On top of that, if the volume is low, then the very act of buying those shares will push the price up so that they're no longer buying in at a good price. Their own buying pushes the price up. And then if they were going to try to sell, the volume isn't there. The act of selling would crater the price. And so the big institutional investors, massive hedge funds, they're not looking at these small cap companies as much, which gives me a competitive advantage. Or maybe a better way to put it is there's just less competition looking at the same group of stocks. So that's where little investors like myself like to look first. So in this particular case, I've got small cap. I'm looking at any industry within the energy sector. I want to see revenue growth of at least 10% on average over the last 5 years. I'm also looking at return on capital invested. And I'm also looking at operating cash flow. And one of the top companies on this screener right here is Dorchester Minerals. $1.5 billion market cap. Revenue growth has been 22%. Return on invested capital is towards the top, second highest. Huge operating cash flow growth. This was one that caught my eye. And when I looked at it, the first thing I noticed as I'm scrolling down is a 13.57% dividend. And if you've been keeping up with my channel, then you know that I typically do not hold dividends in very high regard. I'm more focused on free cash flow, and the dividend is just one use for the free cash flow. But in a case like this, when I'm investing in a small cap company that has just about 100,000 in volume, this dividend acts as a very strong anchor. So this is one of the few circumstances where I actually kind of do like a high dividend, just because no matter what the price action is doing. So on a small cap company with low volume, it's easy for the price to get bullied around. If enough people start selling shares, the price can drop very drastically. And if a small amount of shares get bought, the price can shoot up drastically. It's very volatile. But no matter what the price action is doing, if the price goes down by 10%, 20%, as long as it's still pumping out a strong dividend, then I'm able to continually profit off of the company, even if the capital gains haven't got there yet. As a value investor, sometimes it takes a long time for the market to agree that a company is being undervalued and for the stock price to appreciate. But when the company is paying dividends, as long as the fundamentals are good and the company has a strong business model and it's able to continually make free cash flow, the dividends are going to be a return no matter what the share price is doing. And so I do like that with these small cap, low volume companies. So the main thing that I need to validate as I'm doing my due diligence on this company is, how safe is that dividend? Are they going to be able to maintain the dividend? And so one of the ways that I validate that is I look for analyst forecast. And on stockanalysis.com, normally there's a forecast tab right here between statistics and dividends, and they don't have it because this is such a small company. There's just not any analysts that are covering it. Another place I go to look for analyst expectations is on my Charles Schwab account. I have access to analyst reports. There's nothing. There's no analyst reports on this company. So that was one of my big challenges when I first started looking at this, is how am I going to validate this dividend? And so that is when I started looking a little bit deeper at, what does this company actually do? First of all, let's start with that. What does this company do? Whenever I go to their website and look at their investor relations tab, I can go to their most recent quarterly report where they lay out the description of their business. Dorchester Minerals is a publicly traded Delaware limited partnership that commenced operations in 2003. Our business may be described as the acquisition, ownership, and administration of royalty properties, which consists of producing and non-producing mineral royalty, overriding royalty net profits, and leasehold interest located in 594 counties and parishes in 28 states. So this company owns producing and non-producing mineral and oil land that pays them royalties. And so whenever I go to their financials, this becomes pretty clear. So number one, their revenue is $143 million over the trailing 12 months. Their gross profit is $135 million. So their cost of revenue is only $8.69 million. So when I go down to their margins, their gross margin is 94%. Like So when I first went to this company, before I realized that they were just receiving royalties, all they do is they buy the land and then they receive the royalties, and then they basically pay out all that cash to shareholders. Almost 100% of their free cash flow just goes into a dividend. And so whenever you're looking at the operating margin and the profit, that can be a little bit more misleading because their profits are reduced by depreciation, which goes into the operating expenses. But they have their cost of revenue, $8.69 million, and their selling, general, and administrative expenses, $13.29 million. But pretty much everything is going into shareholders' pockets. So when I go to the cash flow statement, we can see where the cash is coming from. So 53 million comes from their net income. 66 million gets added back because that was that big chunk of depreciation that I spoke about. Then they've got other operating activities. That's a non-cash expense that gets added back in. So their operating cash flow over the trailing 12 months is basically $130 million. And they paid out $146 million in dividends. So in this case, actually more than their operating cash flow over the trailing 12 months, they issued as a dividend. So this company just receives the royalties, hands it to shareholders, and all they're really doing is they're acquiring more land. They're looking to acquire more producing and non-producing land so that they can get more and more royalties. Okay, so we can see a history of that on their PowerPoint presentation. So as I scroll down, if you're familiar with like a well and what the cash flow looks like on a well, typically you put some money into drilling and then you're going to slowly deplete the well. So your cash flow is going to be slowly dropping off with each well, or your available resource that you have is going to be slowly trailing off. And they have a really good chart here that really showcases that. So let me keep scrolling down to the bottom. Right here. Okay. Oops, I passed it. So as we can see, pre-2025 wells. So you can see these wells here, they start producing, but then as their projections go forward, they are showing a declining oil production. And as we go further and further back, pre-2024, pre-2023, pre-2022, each color, you can see that each one is slowly dropping off. And the only way that they're increasing their top line revenue is they're drilling more wells. So 34% of their wells were pre-2025 wells that did not exist in the pre-2024 section. So they're increasing their top line revenue as they're adding more and more wells, and then each well slowly drops off. So that's the game plan. Another huge factor of this company is that the majority of their revenue comes from like what is going on in the world with the energy sector. Is the price of oil going up? Is the price of oil going down? Are inventories going up? Is demand going up? So since this company is just owning the land and then being paid royalties, they don't really have much power themselves over how much oil is being produced. They're really at the mercy of the market. So in terms of future projections, they can't really give me future projections because they're at the mercy of the market. They are just receiving the royalties. So in order to get a decent projection on this company, I need to look at projections in the greater market. So that's my strategy for my forecasting with this company, because I do not have access to my normal resources like analyst reports, for instance. Another item that I would like to point out that I did have access to on Charles Schwab is the Vickers insider profits. This shows insiders buying and selling shares. And this isn't necessarily like conclusive. It doesn't really tell me anything for sure, but it is nice to see that the most recent activity in the last year is all buying. In fact, there's a clump of buying right here. Excuse me. Let's scroll down to the details. So this guy's name is Frank Damon Box, a director. In December, he bought 5,000 shares valued at $22 a share. So this guy just spent, $100,000 on this company at $22 a share. The company is currently trading at $23.73. So it has gone up a little bit since he bought in, but we've been seeing nothing but buying, basically, is what this is. Just a green flag. It doesn't really tell me anything for sure, but it's a nice clue that at least the director in this case thinks that it's a good share price. So Okay, let's move on to my discounted future free cash flow evaluation. So my main tool for calculating the intrinsic value of a company, determining if it is a value company, is this spreadsheet. It is an automated spreadsheet where all I have to do is type in the ticker and then input my assumptions right here. And then this spreadsheet will automatically calculate the intrinsic value based on its future discounted free cash flows. So the first main assumption on this spreadsheet is free cash flow margin. Typically, I will look at the past 5 years, the average free cash flow margin, and then I will use that margin as my assumption going forward. In this case, because I don't really have, I don't have a good feel on what the future is holding with this company. I want to be a little bit more conservative. I don't want to use the average over the last 10 years. I decided to just use the lowest free cash flow margin that they had over the last 10 years. So if I go back to their financials, scroll down to free cash flow margin, as I scroll all the way across, the lowest is 78%. So that is where I put in 78%. This is my base case. I'm also going to put in their average after I get through with this first analysis to see, what is maybe a better case scenario. But for now, we're just going to do the base case. And I just saw Hokage asked, are we looking at rare earth minerals company or energy? This is energy. So I should go to their PowerPoint where they give their breakdown. So this is their royalty production. This is in BOED. This is in barrels of oil equivalent per day. So their production is going up. It's oil equivalent. So it's not just oil. It's barrels of oil plus whatever quantity is of other materials is equivalent to oil. So it could be natural gas, could be liquid natural gas, etc. So I think they do have a breakdown of what is actually producing their revenue. Let me scroll back up to the top. Let's see. Okay, revenue by product, oil, gas, and liquid natural gas right here. So 86% oil, to answer your question. Okay, so that's my first assumption right here is 78% free cash flow margin. The next assumption I need to look at is what is their annualized revenue growth over the next 5 years? So I have put in negative 10%. I'm saying losing 10% of their revenue every year for the next 5 years. I think that is a conservative assumption. Where do I get that? Hold on one second. Okay, where do I get that? Okay, so number one, here's the historical chart, for the price of oil. So, as we can see, obviously it started at $0 per barrel. And then right around here, it starts getting very choppy where oil has become used more and more commonly. And so as we can see, the price of oil has been steadily going up. There is short-term volatility around what's happening in the market. But in general, the trend, just want to point this out, the trend is up for the most part. Okay. So I'm going to come back to this chart in a second, but I just wanted to note the through line is positive. According to, what is this company? EIA.gov. This is the short-term forecast for global oil prices. Okay. So currently the price of oil is 61. They're saying here that for 2026, they're looking at $56 per barrel. And in 2027, $54 per barrel. So they're giving me 2 years of price forecast. So if I look at that on an annualized basis, going from 61 is current, going to 2026, and then going to 2027, that's an 8% drop. Going from today to end of 26, they were at 56, and then another 4% drop. So I'm saying 10% every year for 5 years. I think that's conservative. Based on the current trend, yes, it was dropping rapidly, but it appears to be slowing down according to the forecast. The inflection is trending back towards positive. So I think this is indicative of a reversing trend. Of course, there's no telling. Anything could happen in the future that could completely change the outlook on oil prices. But if we just look at the last 5 years, we can see that since 2022, the price of oil has been dropping. So I'm going to assume that trend is going to continue, losing 10% every year for 5 years. And then at that point, my assumption is that the trend is going to reverse in years 6 through 10 to 2% growth every year, and then a perpetual growth rate of 2%. And I'm picking 2% initially just to match inflation, but doing a little bit of technical analysis, which I typically do not like to do. For everybody who follows the channel, you'll be familiar that I'm not big on technical analysis. I don't pretend to be knowledgeable on it, but just if I look at this high point and I look at this high point, and we draw a line from these two high points to give me an upper channel. And then I do the same thing with this low point to this low point right here to give me a lower channel. So the trend has been in these two channels, has been bouncing between these two channels. If that were to continue, which I have no idea that it will, but that's just the direction that it has been going. I did the math just over here. So the upper channel is increasing at an annualized rate of 4.7%. The lower channel is increasing at an annualized rate of 2%. So once again, to be conservative, I'm going to choose the lower growth rate. So 2% growth going forward over the next 5 years, and then 2% going forward after that. So given this set of conservative assumptions, conservative in my mind, and I want a minimum return based on the discounted future free cash flow of 8.25%, then this company is basically fair value. This is a 6% cushion based on this set of assumptions, which in my mind, I'm using a very conservative free cash flow margin, an overly conservative decline in oil prices over the next 5 years, and then also an overly conservative decline increase in in oil prices going forward. And I just realized I did skip a step. So the company's revenue is heavily correlated to the oil prices. And I just realized I never demonstrated that. So if we go to their financials, we can see that their revenue peaked right here in 2022. It went significantly up from 2021, significantly up from 2020. So 2019, the price, basically I'm about to show you that the price of oil went down from 2019 to 2020 because of COVID. And then the price of oil rapidly recovered to 2022. And then it has been drifting down ever since. That is exactly what the company is showing on this revenue chart right here. And if I go back to the crude oil prices over the last 5 years, we can see that, or we'll do 10 years. So in 2020, oil plummeted. It recovered rapidly up to 2022, and then it has been declining ever since. So basically, oil prices, I'm assuming, are a proxy for this company's revenue growth. Over the last 10 years, this company has grown its revenue at 18%. So to say that they're only going to be able to increase their revenue by the rate of oil's appreciation is also overly conservative, because this company is continually acquiring more and more land. Okay. So all that being said, if I were to go with a more average set of assumptions, let's say they are able to maintain their average free cash flow margin of 85%, instead of the price of oil going down by 10% every year for the next 5 years, let's say it only goes down by 5%. And then in years 6 through 10, they hit a more average increase in oil pricing, a reversion to the mean of 3%, and then a 2% increase going forward. Now I have a 50% cushion, a 50% additional upside. So in my mind, this is a more reasonable set, a more average set of assumptions. The possibility also remains that that oil recovers much more quickly. It doesn't actually continue to drop by 5% for the next 5 years. Maybe after the next 5 years is done, it drops for a couple years and then starts to recover immediately. Maybe the average over the next 5 years is stagnant. Maybe it's just zero, in which case now we have an 86% upside. So given the range of average outcomes, I see a significant upside on this company, and I also see a significant margin of safety. If we see low free cash flow margins, 10% drops in revenue every year for 5 years, then that would put them at fairly priced today, which according to my discounted free cash flow spreadsheet, that is how the market is pricing this company, for 10% revenue drop every year for 5 years, followed by just a weak recovery into perpetuity. Now, so that's my thesis for investing in this company. A couple other interesting observations, and I guess things that were puzzling to me at first. So if this company pays out all of its cash flow, how is it acquiring more land? That was one of my questions when I was looking into this, because they are continually increasing their top line. How are they doing that? So in the cash flow section, if you want to see how much money a company is spending towards acquiring companies, you scroll down to the cash acquisitions. And at first glance, I was like, okay, that's not as much cash as I thought they'd be spending. 14 million, 2 million, that's pretty cheap, I guess. I thought it would have been tens of millions or hundreds of millions maybe. Because if you look at their balance sheet, in terms of assets, they have $330 million in assets. How are they acquiring all these assets? And then it got even more puzzling because I realized that these were actually positive numbers right here. If cash is flowing out of the company to buy land, this should be a negative number. So not only is it a small amount of money, it's also cash going into the company. So, it was very puzzling to me at first. And then I realized, after reading through their most recent quarterly report, if I scroll down to acquisitions, they make their acquisitions in exchange for common units. They are buying land by giving shares. So number one, they don't have any debt, right? They're not having to get loans. So if I go back to the balance sheet, so this takes some of the risk out of the equation. Is total current liabilities. They have some leases, but they virtually have zero debt. 6.8 million in total liabilities, and they have 41 million in cash. So they don't have any debt. However, they are constantly diluting shareholders in order to acquire more land. Now, as long as the land is generating enough royalties to account for the dilution, that's fine, right? But that is a potential problem. So the way I looked into this is I went to the cash flow section once again, first let's look at the income statement. This is where it shows the dilution. So, and this is a significant amount of dilution. If I going all the way back, they had 31 million shares back in 2015. Now they've got 47 million shares. So they have diluted, a few percentage points here and there, 3, 2.5, 5, 1%, 7%, 19%. So this is a significant dilution over the trailing 12 months. So that looks a little bit alarming, but the way that I determine is it worth it is I go back to the cash flow statement and I look at free cash flow per share. So if they are diluting faster than they are able to acquire more and more free cash flow, then I would see the free cash flow per share dropping over time. And what do I see right here? Free cash flow per share over the trailing 12 months, 2.73. If I go all the way back in time, 0.9. So 0.9, 0.9, 1.9. And then once again, this is also correlated with the price of oil. So their free cash flow per share peaked. This is in 2022 when the price of oil peaked. So they had $3.91 in free cash flow per share, and then it has been drifting down since as the price of oil is dropping. But this company is continually acquiring more land. So in this section right here, acquisitions for common units, on August 29th, they acquired 3,050 net royalty acres located in Adams County, Colorado, in exchange for 100,000 shares, common units. July 1st, or sorry, no, never mind. Okay, here we go. On September 30th in 2024, they purchased a whole lot of land. Where is it? 14,225 net mineral acres located in 14 counties. So that was on September 30th. Scrolling down, another one on September 30th. 1,000 acres. So anyway, as you scroll down through their most recent quarterly report, you can see that they are continually acquiring more and more land. And ideally, when the price of oil eventually does recover and start to trend back in the direction that it has been for the last 50 years, then all of these acres that they're acquiring is going to result in additional free cash flow per share. So that is my investment thesis for Dorchester Minerals. Once again, I find this company very interesting because it is currently priced in terms of free cash flow lower than what the value of oil forecast looks to be. And it is paying currently a 13.5% dividend, which acts as a very strong anchor for the share price. The share price really, unless something very material is going wrong with the company, the share price is probably not going to drop too much, because if they are able to afford to continually paying the dividend, then investors are going to scoop up, like let's say the price drops by half, investors are going to be scooping up the 26% dividend. The dividend doubles if the price drops by half. So as long as the company is strong, and we got to continually keep up with this company, as long as the company is strong and they're paying the dividend, then I will always be getting a return out of this company, regardless of what the share price is doing. So as a value investor, it does kind of accelerate the returns that I'm getting. I don't have to wait for capital gains. I don't have to wait for the market to necessarily realize that this is a strong company. It just has to keep paying the dividend, and I'm completely fine with that. Now, there is a lot of uncertainty with this investment. I do not know what is going to happen with this company. I do not know what's going to happen with oil. All I can do is look at history, look at what the projections are for the price of oil, look at the past performance of this company, try to assess the risks, and kind of create a couple narratives that are reasonable and see, is the risk worth it? And in this case, I think the risk is worth it. This is one company out of, I believe, 43 companies. So we are highly diversified. If this particular investment does not work out in the energy sector, then I have other energy sector companies that I can rely on. Well, I don't have that many because I really was under invested in the energy sector, in the material sector, and in the industrial sector, but we are looking to correct that. So in the industry sector, we currently just have 3 companies now: Canadian Natural Resources, Vermilion Energy, and now Dorchester Minerals. And our energy sector is green, at least, so that's not too bad. But yeah, we're going to be investing $200 into Dorchester Minerals. I'm also going to be investing $50 into an existing holding that I believe to be more undervalued. And there's a little bit of a shortcut right now for me, because I just rebalanced my portfolio, but in the consumer discretionary, there's tons of red. So this is the first area that I'm going to be looking, is Trip.com. Is this 16% drop warranted? There's one more category that I'm strongly considering. I have not looked into Trip.com yet, so that may be something for next week that I need to do a little bit more preparation for. But where is it? Okay, here's my small cap value portfolio. I just rebalanced. Nexen looks incredibly undervalued. When I did my rebalance, it's dropped by 8% since I did that rebalance. And so I'm going to be putting my extra $50 into this company this week. Next week, I've got a few that are in the red that I need to look into and see, like, is this just the typical volatility? The market is just selling off these companies a little bit and they don't deserve to be, in which case I'll be putting in another $50. Or, hey, maybe something is going wrong with the company and it's going to adjust my discounted future free cash flow evaluation, in which case I may end up selling out. Like Trip.com earlier was down 17%. There could be something that just came to light that completely changes my opinion on Trip.com. Oops. This is TCOM, right? Yeah. 17% today. So it literally just dropped off. So I guess they probably had their earnings report come out. So this is one that I need to look at. Does it change my assessment of the company? It could be A, more undervalued than ever. It could be B, still roughly the same undervalued, and their situation just got a little bit worse. Or it could be that it's now overvalued and I no longer want to hold the company. So that is my exit strategy. how does it look on my discounted future free cash flow spreadsheet? If it's undervalued, I buy or hold. If it's overvalued, we sell. So that's the strategy. So that's all I have for today. Hokage or anyone else who's watching, if you have a company that you want me to look at, that we can quickly run through a discounted future free cash flow valuation, I'd be happy to do that. Otherwise, or if you have any other questions about Dorchester Minerals, anything you think I may have overlooked, or if you have any comments or opinions on this company, I'd be interested to hear. Other than that, I think if nobody has any questions or companies for me to look at, then we'll probably just call it a night. So yeah, Dorchester Minerals. 13.5. Oh, and one thing I forgot to bring up. Oh, Hokage, it was up 32% since your stream, now back down, unfortunately. Fear in the market. Yes. Yes, indeed. Yeah. There is a lot of uncertainty in the market. So that is both a good thing and a bad thing. It's a little bit of a double-edged sword because it does create a lot of opportunities, but some people, they won't be able to continue to hold the stock through the volatility. Some people are forced to sell for personal reasons, and those people, there will be lots of people that lose money when the market is very volatile. Fortunately for me, I'm only investing money that I have a very long time horizon with. So, I'm a long-term value investor. So I have plenty of time to wait for these companies to eventually become fair priced, or ideally they become overpriced, and that's when I sell them. So anyway, antitrust probe always messes up these Chinese tickers, similar to BABA. Oh, okay. So I hadn't heard that. Antitrust probe. Yeah, that was holding Google back for a long time. And then when that got pulled back, Google absolutely popped off. Yeah, look at that. We were buying Google around here, around $150. It's too bad we didn't load up even more. I think that was one that we doubled down on just once, maybe twice. I can't remember for sure, but Google has since been, we've rebalanced the portfolio. Let me see. What is Google at now? Yeah, Google did reverse like a slingshot. Okay, tech. What do we have in Google? Google, it looks like we brought Google back down to just a single unit, about $120. So yeah, last I looked, to me, it looked like it was pretty much fairly valued. Let's look at my activity with Google. What did we do? I can't remember. I can't remember how much we bought. Okay. So we initially bought Google on January 29th, 2025. Wow. A year ago. January. Oh, we bought at the peak, this peak. And then when it dropped, we bought more. In May, we bought more. In May. Yep. This is where we did better. April, May, not the very bottom, but we did pretty well. April, January and May, and then we sold in January. So we sold up here. So we ended up doing pretty well with Google. And I didn't sell all of it. We bought $200 worth. I sold $242 worth. And now we still have 120 in the portfolio. So anyway, that's all I got. Hokage, I appreciate you tuning in, man. We'll see you next time. Let me know if there's any companies you want me to look at, and we'll check it out. Have a good night.